Money is not what you think. Money feels simple until it disappears faster than expected, leaving confusion, stress, and unanswered questions behind daily financial decisions most people never truly understand deeply. We work, earn, save, spend, yet still feel trapped financially, suggesting something fundamental about money is rarely explained properly. Financial systems look mathematical, but behind every rule lie human incentives, power structures, and historical compromises shaping outcomes. If money were fair and logical, hard work alone would guarantee stability, yet reality consistently proves otherwise. People blame themselves for financial struggle, unaware they are navigating systems designed without education transparency. Understanding finance is not about becoming rich, but avoiding invisible traps quietly draining time and effort. Every major financial concept connects like gears inside a machine most never see operating. Once understood, money stops feeling mysterious and starts feeling predictable. Predictability creates confidence, and confidence creates better decisions. To reach that point, we must start at the beginning. Why money and taxes exist? Early societies traded goods directly, but barter failed when needs did not align conveniently. Money emerged as a shared agreement to simplify exchange and store value over time. Governments later formalized money to organize societies, fund armies, and maintain order. Taxes were introduced as mandatory contributions to sustain public infrastructure and authority. Roads, schools, sanitation, and defense required collective funding beyond voluntary donations. Tax systems evolved alongside states, becoming more complex as societies expanded. Income tax targeted earnings, sales tax targeted consumption, and capital gains targeted investment growth. Social Security forced savings for old age, solving long-term survival risks. Medicare pooled health risks across populations. Taxes became civilization's operating fee. Banks and the illusion of storage banks did not begin as vaults, but as intermediaries connecting savers and borrowers. Deposited money is rarely stored untouched inside buildings or safes. Instead, banks lend most deposits to others seeking loans. This system is called fractional reserve banking. It works because not everyone withdraws money simultaneously. Depositors receive convenience, safety, and small interest incentives. Borrowers gain access to capital they could not otherwise afford. Banks profit from the interest difference between deposits and loans. Trust holds everything together. When trust breaks, systems collapse rapidly. When banking fails, bank runs occur when people panic and demand withdrawals simultaneously. Banks cannot fulfill every claim instantly. Fear spreads faster than facts. The 2008 financial crisis exposed this fragility globally. Loans failed, assets collapsed, and institutions froze. Governments intervened to prevent economic implosion. Bailouts protected banks to protect economies. Losses became public burdens. Profits remained private. Trust was shaken but not rebuilt structurally. Interest. The silent force interest is the price of borrowing money. It rewards lenders for patience and risk. Simple interest grows slowly and predictably. Compound interest grows exponentially over time. Debt compounds against borrowers. Wealth compounds for investors. Credit cards demonstrate interest's dark side. Missed payments snowball rapidly. Investments reveal interest's power. Time determines which side wins. Money losing weight. Inflation quietly reduces purchasing power over time. Prices rise while money's face value remains unchanged. Too much money chasing limited goods causes inflation. Supply shortages raise costs. Expectations accelerate inflation cycles. Moderate inflation supports economic stability. High inflation destroys savings. Governments raise interest rates to slow spending. Higher borrowing costs reduce demand. Inflation punishes inactivity. Economic breathing recessions are periods of economic contraction. Jobs disappear, spending slows, fear dominates. High interest rates restrict borrowing. Global crises disrupt production. Economic cycles repeat historically. Booms create excess. Busts correct imbalance. Governments stimulate demand. Recovery follows pain. Scars remain long-term. Trust measurement. Credit scores measure reliability, not wealth. Lenders assess repayment probability. Payment history dominates scoring. Utilization reflects discipline. Account age shows stability. Credit variety adds confidence. Frequent applications signal risk. Late payments damage trust. Good scores reduce borrowing costs. Bad scores restrict opportunity. Investing, value, and time. Investing protects money from inflation. Stocks represent ownership slices. Bonds represent loans. Funds diversify risk. Real estate leverages shelter demand. Value exists through perception. Scarcity increases worth. Skills create leverage. Time multiplies returns. Patience beats luck. Takeaways. Warning: call to action. Money is a system, not a moral judge. Understanding prevents costly mistakes. Financial ignorance benefits institutions. Education restores control. Small habits compound massively. Debt enslaves time. Investing frees future choices. Value creation drives income. Time is irreplaceable. Subscribe to master money before it controls you.